Our next exercise considers a multinational corporation selling its goods and the calculation of its profits. We already know how many goods are actually being produced in China, Brazil, and India, and how many from each market are sold in Sweden, Germany, Ireland, and the United States. But what we want to calculate is the final profit. Actually, this decision as to how much to produce is actually also a result of an optimization model in Excel, which we can look at in the next course regarding the optimization modeling, which doesn't really fit into this course's material. Now, with multinational corporations, there's one issue that's called transfer pricing. Transfer pricing means that the multinational is always able to select a tax rate that is lower. Let's see how it works. For instance, let's say that the multinational produces in China and sells in Sweden. In Sweden, the income tax rate is 36%, and in China it's 30%. This means that the multinational will have a producing subsidiary corporation in China and a selling subsidiary corporation in Sweden, and what it will have to do is it will have to sell its products within the firm from China, where it was produced, to Sweden, and it will have to sell it in such a way that all the profits will be realized in China. This means that goods move from China to Sweden already at the final price, at the price with which they're sold on the market. And then all the profits come in China. And Sweden already buys them in with final price, sells them to the customer with the same price, and has zero profits. So, effectively, lower number has been chosen. Let's take another example. For instance, if we manufacture in Brazil but sell in Ireland, we have a situation that's completely reversed. Namely, we manufacture in Brazil with the income tax of 35%. We sell in Ireland with the income tax of 20%. This means that we will have to sell the goods from the Brazil production subsidiary to the Irish selling subsidiary with the same cost at our costs. So if it costs us a certain amount to manufacture, we will sell it with the same price as the costs. Thus, the Brazil subsidiary will have no profits at all. The costs were the same as the selling price to the Irish subsidiary of our own multinational corporation. Has two companies, one in Brazil and the other is in Ireland. Now, from Brazil it sells to Ireland with the same price that the production cost was, which means that Brazil gets no profits at all. And now Ireland sells to the final customer at the market price, which means that he gets all the profits and again pays a lower profit income tax. Thus, the multinational can always try to use transfer pricing and select the lower income tax. Let's write down the formula for this, and it turns out that it's really rather simple. We just have to write equals minimum of these two, of the 30% from I6 and of the 36% from D10. The minimum of the two tax rates from China and Sweden is the one that's being chosen. Now, to the dollar signs. This time we have the headers on the lower part and on the right part. So we have to fix them again. As always, with I6, we don't want this I6 to move left-right. Thus, dollar signs before I. And with D10, we don't want the copying to move the green D10 to up-down. thus dollar signs before 10. We want the green D10 to move left and right, no dollar signs before D, and we want the blue I6 to move up and down, so no dollar signs before 6. And here we have it. We can copy this formula now, and we get this effective lower tax rate. Okay, so now I know, for instance, that if we sell from Brazil to Ireland, our tax rate is 20%. Okay, and for instance, from Brazil to USA, it's the USA's 25% tax rate, but from India to USA, it's the India's 22%. So that's how it plays out. Now the next thing we need, we already know how many we're shipping, but we need profits from one shipment, and then we get the total profits for the multinational in this time period. And now to get the profits for one shipment, what we have here, we're producing in China, we're selling in Sweden. Our selling price is 19,000. Our production cost is 14,000. The difference between the two gets our shows by how much our sales is above costs, and then we're taxing it with this lower income tax rate that we already spoke of, and let's do that now. Okay, let's write equals parenthesis. Now comes sales price D19 minus production cost I15. Parenthesis closed, we multiply it with, and now we want to know how much profit is left. So we write parenthesis 1 minus this 30% from up there. So 30% is taken away by the states, and now we are left with this 70%. Okay, now let's see the dollar signs. This D6 has to move up and down, left and right, so there is no dollar sign in there. D19 is the lower header, which means that the 19th row will be fixed. And I15 is the right side header, which means that I will be fixed. Well, it's just exactly the same purposes as we spoke of just a bit earlier. Now the next thing, we can just copy this formula now, and now we can see here are profits for one produced unit. The biggest profit for a produced unit is when we ship it from China to Germany. The sales price is the highest in Germany. Actually, the production costs are the lowest in China. But what about the taxes? Germany 31, China 30. So as we're selecting the lower one, we will have 30% selected. This isn't that low, but I guess the sales price and production cost being so high and low respectively are what contribute to this highest profit. And the lowest one is to produce in India and sell in Ireland. Okay. Now, let's calculate our final profit, which is really straightforward. It's just the ordinary use of some product equals some product, parenthesis begin, and we take those profits per one unit sold and the number of units sold, and it's the all-in-all value is $60 million, which is the optimum for our company.